What's up, guys? This is Lucas from IntraAlpha, and on today's video, we're going to be talking all about volatility. High volatility, low volatility, historical volatility, implied volatility, and everything in between. So if you are new to options trading or you're finally starting to graduate to some of those intermediate style strategies, then this video is for you. First up, we should probably just go ahead and state that implied volatility and volatility in general is probably the most important underlying concept in all of option trading. And the reason is that people are buying options to protect against volatility, typically downside volatility in the form of put contracts. With all that being said, implied volatility is the price that people are willing to pay to protect against that volatility. When things are going crazy and there's big drawdowns in the market, or even there's violent moves up or down, people are going to be bidding up option prices. Both calls and puts become more inherently expensive relative to the price of the underlying because people are more and more willing to pay a higher and higher price to protect against that volatility. So let's dive into some of these definitions and the basics. Implied volatility is a two-word phrase. Let's break it down. The first word is implied, meaning it says something about the future. What the price is today makes an implication about what may or may not happen in the future. Volatility is how much does the underlying price move. Now, something that's very smooth and doesn't move a lot, say Coca-Cola stock or Johnson & Johnson, is going to have a low implied volatility because traders know over the past 1 week, 1 month, 1 year, or 10 years that those stocks simply do not move up or down as frequently as other stocks. Therefore, the price of the insurance, the price of their volatility would be less relative to something like Nvidia or Carvana, which moves around a lot. Another way to state that is implied volatility really is the market's anticipation of the future movements of the underlying. It's sort of the weather prediction of the next week ahead or month ahead, depending on what your expiration cycle may be. If the market thinks that storm clouds are coming, they're going to bid up implied volatility, and therefore the price of your options are going to go up. But if the market thinks that it's relatively smooth sailing ahead, then the opposite is true. Implied volatility is going to come down and your option price is going to come down. Now, a lot of people still get this really confused. Implied volatility is not a Greek. It's not a derivative of the Black-Scholes equation. The implied volatility literally is the price of options that traders are setting in the market today, right now. What are they willing to pay right now for that insurance contract, for that put contract? That price, relative to the price of the underlying, relative to how much time is left, is what implied volatility is. In simpler terms, a high IV simply means that the market believes that the stock is going to move around more than it would be otherwise if you were in a low IV environment. Low IV means the exact opposite. It means that traders think the stock isn't going to move around very much. Again, all sunny skies, there's no storm clouds, everything seems smooth, therefore, why would I buy puts? In fact, I might as well close the puts that I already have with a sell to close order. When you sell to close those puts, you are decreasing the price of volatility. You're willing to close that position. You no longer want it. The demand for puts is decreasing by one contract. That's you closing that contract. As other traders agree and go to close their contracts, it's going to push the price of puts down. That's going to lower the implied volatility. Now, there isn't some metric where traders are saying, hey, I only want to pay X in implied volatility. That's not what they're doing. Instead, they're looking at the price of the contract, which they should. But if you know what the price of the option contract is, and you know what the price of the underlying is, and you know how much time is left, then you can derive what implied volatility might be. Now, it's an important distinction to note that implied volatility does not imply a direction. In fact, it's one number that loosely captures the potential up movement and the potential down movement of an underlying stock. So don't think that there is some sort of directional or delta implication as to where the stock's going to go. A high implied volatility stock doesn't mean that it's going to go down. It does mean that people are willing to pay a higher and higher price for the options against that underlying. Maybe they believe it's going to go up, so they're bidding up calls. Maybe they're scared it's going to go down, so they're bidding up puts. You could have a situation where people are only bidding up puts and they are not bidding up calls, and the implied volatility of puts is going to be much greater than the implied volatility of the calls. Does that mean that the stock's going to go down? No, but it does mean that a lot of traders have put bearish bets on that stock to go down. Is it a self-fulfilling prophecy? Are they shorting the stock? Those shorting the stock typically push the price down? Sure, if the bears can overwhelm the bulls, then the price will go down. But that is not the same as saying that a high implied volatility of puts relative to a low volatility of calls means that the stock is going to go in any particular direction. It might give you some insight as to whether or not you want to buy those puts or buy those calls. It might give you some insight as to whether or not those puts or calls are expensive or cheap relative to the historical movement of the underlying. But again, it doesn't give you any directional implication as to where that stock might go. So let's look at this a little bit further using some examples. Let's say that we're trading Apple calls and the at-the-money call that expires in 45 days is trading for $3.15. If that exact same call with 45 days until expiration was trading for $5.15, that would be a much higher implied volatility option. Conversely, if that same option contract, which expired in 45 days, was now trading for $2.15, that would be a much lower implied volatility contract. So as you can see, a higher option price relative to everything else being held constant equals high implied volatility. A low option price with everything else being held constant would mean a low implied volatility option contract. Now, this is an important distinction because thus far, we've talked about implied volatility, meaning what does the option market think about the future? What we're going to shift to now is what's considered historical volatility, or some people call it realized volatility. So the market might be pricing in big wild moves from Apple, but let's actually look back. Over the past 45 days, how volatile has Apple actually been? You use some math and statistics, the same math and statistics used to calculate implied volatility, but you apply it retroactively, looking backwards in time at what really happened. When you run that math, you can arrive at a figure which can be called historical volatility, which was computed in the same way as implied volatility. Comparing historical volatility to implied volatility might give you some insights as to whether or not that option contract is expensive or cheap relative to what happened in the past over the same amount of days. Okay, so this calculation isn't too complicated, and if you've passed high school math, you should be able to figure it out. First of all, you just get a series of the close prices of the underlying. You're then going to calculate the daily returns by calculating what is today's price minus what was yesterday's close price divided by yesterday's close price. That's going to give you the percent gain of every single day during that period. The next step would be to calculate the standard deviation of those returns. Once you have the standard deviation of those returns, you want to annualize that figure so that you can figure out what is the historical volatility. To annualize it, you want to take the standard deviation of your daily returns and multiply it by the square root of 252. Why such a specific number? Well, because that is typically the number of trading days in a year. And so to get the annualized standard deviation, you're going to get your standard deviation during the period and annualize it using that square root of 252. Now, if you're an engineer, this is pretty easy to whip up in Python. There's tons of open source libraries that will calculate this for you. But here's a quick look at how this function might work if you were to program it in Python. So now let's review a couple of these terms so that we can start to compare historical volatility and implied volatility in a better way. We really want to be apples to apples so that we can determine if people are paying too much or too little for those option contracts. So the first one is just volatility. How much does the underlying move? Well, we found that out historically, and we can look at the implied volatility to determine how much people think it's going to move in the future. The historical volatility is what we just covered, and it's a known fact. We can calculate that down to the level of detail that we need so that we can compare it to implied volatility, so that we are comparing apples to apples and can make a determination as to whether or not those option contracts are cheap or expensive relative to what has actually happened in the past. So if you're trading Apple stock and you run this math, you might determine that Apple stock in the past has had a historical volatility of 0.3. And when you look at the options market for the period in question, you might see that the implied volatility is actually 0.45. That means that option traders are willing to pay almost a 50% premium on the future volatility relative to the volatility that actually happened in the past. Apple stock might have moved a moderate amount in the past, but option traders are pricing in an aggressive move in the future. There is a 50% premium. They are paying 50% more than they otherwise should be paying if history repeats itself and Apple has a realized volatility similar to its realized volatility from the past. In this situation, the options market is overpaying for those options, and those options could be considered expensive. Now, nobody knows the future. Maybe Apple has a ridiculous move coming that nobody sees coming, in which case those options could turn out to be cheap. The call option could blow through, and it could be an amazing trade to have bought those calls. That also could apply to the puts. But given what we know about the past, and given what people are pricing about the future, you can still say today that people are pricing in a greater move for Apple during the period than has actually happened during the similar period in the past. Is that a trading signal? I'll leave it up to you, but if traders are overpaying for options, it's almost always good to take the short side of that bet and sell those expensive options to them. In a previous video, I used the analogy of rental car insurance. And the question is, what is the right price to pay for you to rent that Toyota Corolla for 1 week? Do you want to pay that extra $180 to insure the car and your own liability, even though you already have insurance? Well, that's a question for you to answer, but it is a question that can be answered using math. What is the price of the Corolla? How long are you going to be driving it? How good is your driving record? How likely are you to get in an accident during that time period? And what is the average cost of that accident if it were to occur? If you knew all those figures, you could compute what the fair price of that insurance would be, and you shouldn't pay a penny more than that. And that's the same type of analogy that applies in the options market. Are those options fairly priced, or are they cheap, or better yet, are they expensive? Let's give another example that's even simpler. What is the probability of a coin flip landing on heads or tails? Let's say it's 50%. Yes, sure, in some alternate universe or over millions of flips, you can get the coin to land on its side, but we're going to ignore that for now, and we're going to say that there is a 50-50 chance of landing on heads or tails. If a casino were to offer you 90 cents for a $1 bet if it landed on tails, and $1.10 for a $1 bet if it landed on heads, which are you going to bet on? Between heads and tails, which probability is overpriced and which is underpriced? The answer is pretty obvious. Given that it's a 50-50 chance, you're going to want to take the bet that pays you more than a 50-50 realized gain. You want to take that $1.10 payout instead of the 90-cent payout. The seller during this game, the casino, is implying that heads is less likely to occur. That's why they're willing to pay you $1.10 if it lands on heads versus 90 cents if it lands on tails. Do you know something about heads and tails that would allow you to disagree with them? They think that heads is less likely. You think that heads is 50-50. There's your alpha, there's your trade. The heads is underpriced and the tails is overpriced. So what would you do? You'd obviously bet on heads. It's super clear that this is the superior strategy. Betting on tails in a 50-50 environment is going to underperform betting on heads with all things held equal. You know a lot about the historical volatility of a coin flip, and you disagree with the market's pricing of what a tails would be or a heads would be. Betting on heads every time is going to be a profitable strategy. Now, the beauty of options trading and the financial markets in general is that you get to play both sides. If you could, the profit maximizing situation would be to sell the tails bets and you would be buying the heads bets. If you knew it was 50-50, then you should trade dollar bets for 90-cent payouts all day long on tails outcomes, and you'd be willing to spend $1 to get $1.10 back if you are buying the heads outcome. And the reason is heads are cheap and tails are expensive. Now, as an option seller specifically, you really need to pay attention to this relationship. The relationship to implied volatility and historical volatility is typically what your edge is. If you're not playing vol, if you're not selling volatility, then you're really just in the delta game, betting on the direction that the stock is either going to go up or down. And that's fine. A lot of your gains might come from delta, but you're missing out on the edge provided to option sellers, the edge provided to insurance sellers, the edge provided to people who sell the game to you, the casino, the insurance companies. These folks are overpricing what the real odds of the outcome really are. The casino, the insurance companies, these folks are overpricing what the real odds of the outcome really are. Option buyers have to pay up for that, and option sellers get to set that price and collect that premium. And with that in mind, that's why you always want to be selling expensive options where the buyers are paying way too much for that premium. They are overpaying for that option for something that is less likely to occur than they realize. Now let's look at some volatility trading opportunities. When implied volatility is very high, you typically want to be an option seller. So after a big sell-off in the market or on a potential stock, you're going to realize that put contracts are bid up. They have a very high implied volatility. And even though you just got through a period of very high realized implied volatility, historical volatility, you can still make the choice that, hey, maybe that sell-off in Meta is done. Maybe the sell-off in Tesla is over now, and we're going to start to drift back up. That would be the perfect time to sell a cash secured put or to sell a put credit spread, because people are still overpaying for those put contracts, but the storm might be over. The storm is now blowing out to sea, and selling those put contracts are going to be extremely profitable as everybody else in the market is closing those positions and implied volatility starts to collapse after that big event has taken place. Low IV environments typically are going to lend themselves to be for option buyers. The price of a future move is so cheap that it actually makes sense to buy it. If you see that a particular stock has moved up aggressively and a lot in the past and has a high historical volatility, but the implied volatility of the calls, let's say, is low relative to historical volatility, it might make sense to buy those calls. The market seems to have forgotten that that stock can move up and move up quickly. Therefore, the implied volatility is low, but the past has shown that those up moves can be very abrupt and very aggressive. Therefore, buying that call option might be a good trade. Now, there's another way to look at the options market and determine some level of potential alpha. When you look at the volatility of puts versus calls, and you were to plot that volatility, the volatility of each put strike at a particular expiration versus the volatility of the call strikes at that same expiration, and you were to plot them on a graph, you're going to see that typically the puts and the calls are not priced in the same way. This is the volatility smile. This is the put-call spread. Are people buying up puts at a higher and higher rate and more aggressively than they are with calls? If so, those calls are going to have lower implied volatility than the puts. What does this mean? It might not necessarily mean anything, but if you look into it, you might be able to see some anomalies or some tradable opportunities. If puts are 2 times the implied volatility of calls, you should start to wonder why. What does the market know that I might not know? Is there a big event coming up? Are earnings coming up? Is there some geopolitical risk that's being priced in that we don't quite understand? maybe there's a recession risk, it should give you pause to wonder why so many traders from all around the world all believe that these puts are worth twice as much as a comparable call. What is it that they know? Another use of implied volatility is as a hedge. If you are a short option seller and all you do is sell options, then you're going to end up with a portfolio of short option positions. All those short option positions are going to be negative vega, which means as implied volatility rises, that's going to hurt you. So how do you hedge against that? Well, you need to get long vega. An easy way to get long vega is to say buy calls on the VIX. As implied volatility goes up, the VIX is going to go up, and therefore those calls are going to make you some money. Now, is that going to perfectly offset the losses on your other short option positions? No, probably not, but it is going to lessen the blow and help limit those losses if something really drastic happens in the market and everything starts to move against you. Another way would be to hedge your volatility risk or your vega risk on the individual positions. So say you have an iron condor and it's doing well so far, but you're a little bit worried about the upcoming earnings and you want to kind of hedge your position in case a stock moves in a crazy way against you. Your iron condor expires in 60 days, but the earnings event is in 6 days. What are you going to do? You could buy some shorter term options, like buy the at the money call or the at the money put that expires in 14 days. These shorter term options are going to move a lot more. They're going to hedge your vega exposure. And if the market moves in a crazy way, those short term options are going to pay you out because you are long those options. My point is that you can hedge that iron condor by going long options with a shorter duration and just spread that vega risk out across the calendar. There are two other relevant metrics to consider when looking at implied volatility, and those two metrics are implied volatility rank and implied volatility percentile. If you were to look up, let's say 10 out of the money calls and 10 out of the money puts on a particular stock for a particular expiration, say 45 days from now, you could get a blended or weighted average of implied volatility for that underlying when assuming a 45 DTE expiration cycle. If you were to ask that question and compute that value every single day over the course of a year and plot it on a graph, you would get a time series of how expensive what the implied volatility was for the option contracts expiring 45 days from now on that particular stock. If you were to look at that graph, you could then compare today's value, today's blended average of implied volatility for that expiration cycle against what it typically trades for historically. And using that information, you could arrive at an IV percentile. Out of 100 occurrences, is it in the 99th percentile, meaning it's very expensive, or is it in the 1 percentile, which means it's very cheap? Again, cheap and expensive are relative, but what is it relative to? In this example, it's relative to the previous occurrences. That's going to give you the percentile of where IV is sitting currently. A similar but different way to look at this is implied volatility rank. Implied volatility rank is going to look at where that blended implied volatility average is today relative to where implied volatility has been in the past. So it is, again, a comparison of today's value versus history, but it's not compressed into a percentile. It is ranked over time. So if you look at, say, the average implied volatility is the current implied volatility 2x that, 3x that. In this way, you're going to get values that you could have an implied volatility rank of 150% or 300% versus the implied volatility percentile is all going to be normalized to a 0 to 100 scale. In my opinion, I like the implied volatility percentile because to me, it compares apples to apples across stocks, and you can really answer the question in a consistent way. How expensive are these options today relative to the past? Keep in mind, if you compare implied volatility and historical volatility, that is comparing the price of the future versus what really happened in the past. With IVR and IVP, you are not actually doing that. Instead, you're comparing the current applied volatility to what implied volatility was in the past. So notice there is no mention of historical volatility here. Instead, it is a historical plot of what implied volatility was in the past. Another big way that implied volatility comes into play is on earnings events or other binary events. You really need to pay attention to how implied volatility moves as those events get closer and closer. So, using earnings as an example, you're going to see implied volatility rise as that event gets closer and closer. This is because traders are bidding up their insurance on a potential move up or down. Once the information comes out, those traders typically close their positions either for big wins or for losses. But because the information is now realized, there is not such a high need to buy insurance for its potential. You know what you have now. And so people start to close those insurance products. They start to close those option contracts, and implied volatility collapses. This is also known as implied volatility crush, and it is one of the most well-known and most commonly traded volatility trades in the market. Now, if you're trying to trade a option strategy, it can be helpful to consider what the macro environment is in terms of volatility. Are we in a high IV environment or are we in a low IV environment across the entire market? Once you have that answered, you can start to look at your particular stock and say, is this stock in a high IV environment or a low IV environment? Once you have that answered, you can start to deploy the correct fit option strategy for that particular environment. In low IV environments, you tend to want to be long options. That means buying calls or buying puts because the price of those options are so cheap that it can be profitable to own them or to at least trade them for short duration. If you want to take it one step past short, long legs like calls and puts, you would then step up to debit spreads or long strangles or long straddles so that you can capture the potential move in the market with a little bit more complexity or a more nuanced position. If you're in a high IV environment, you basically want to be an option seller because people are overpaying for those options. You want to be selling cash secured puts or credit spreads or covered calls. Beyond that, with a little bit more complexity, you can get into ratio spreads, iron condors, calendars, and other ways to sell volatility to the market in a way that allows you to capture the overpricing of that premium. So now, how do you use all this information in your trading? Before you put that next trade on, you really want to consider what the IV environment is. How does it compare to historical volatility? How does it compare to its own implied volatility over time? Once you have a better understanding of volatility, you can start to make choices as to what types of trades to put on or when to put those trades on instead of just following the price or direction of the underlying. Should you be long or should you be short needs to be answered by implied volatility, not just the price, direction, and volume of the stock itself. You also want to take into account the historical nature of implied volatility. And what I mean by that is you can consider the realized volatility, the historical volatility of the underlying, and compare it to the implied volatility of the underlying. And you can consider the historical implied volatility of volatility itself. That would be IVR or IVP, and consider comparing that to the current IV rank and the current IV percentile. Are options cheap? If so, buy them. Are options expensive? If so, you should sell them. Now, if you have questions about implied volatility, historical volatility, or how this all applies to your option trading, please leave your questions in the comments below. If you found this video helpful, please like the video and subscribe to the channel so that we can keep making content like this. And as always, thanks for watching. I will see you on the next video.